This is the Value Investor Podcast with Tracey Ryniec. All things value, all the time.
Welcome back, value investors. So many times on this podcast, we've talked about the small cap value stocks, and we've talked about how historically they have been the best performing asset class. Yes, even better than large, better than mids, better than all of those. And small is kind of where you need to be if you are a value investor. But over the last 15 years, the small caps in general, but also small cap value has really lagged. And a lot of that is because it's heavily invested in the banks, the small community banks. And as we know from the Great Recession, those have really struggled to recover and then even to break out. I'm still of the belief that ultimately we will get a breakout in those community banks. We might even be getting one possibly right now here in 2025. But until it's confirmed, until I have people asking me which bank should I buy, which is not happening, then they're still in the doghouse. And the small cap banks really make up about 18 to 20%, depending on which of the small cap indexes you look at. And they are a big chunk of the value small cap indexes if you own one of those. So some of that is the reason that it has really lagged. But another reason is large caps are just dominating. We now have these trillion-dollar companies and everybody wants to be in them. We have the Mag 7, we had the FANG, we had the FANG Man, all these companies involved in AI and on the technology side. There are small caps on the tech side too, of course. And we're going to see quite a bit of those on the AI side of things. I've been covering some small caps. They're not necessarily values, but some of them have been with our small cap analyst here at Zacks, Mark Zinski, because he is the actual analyst analyzing these companies. I'm just the strategist looking at all the markets and what's going on with the rank and all of that. But he's the expert on the small caps, and he's been uncovering a lot of really interesting small caps in the AI side of things. Those will start off small, but as the AI revolution expands, hopefully some of them will catch a bid, basically. And, whoever was the alphabet of today, from back in 2000 when the internet was just getting started and these new companies were showing up, someone will be the alphabet out there, or take your pick of whoever else was big at the time, even Microsoft. Microsoft's back again, but remember when Microsoft and Apple were small companies. So everybody's got to start somewhere. And that's why you do buy the small caps. But as I mentioned, the big caps are running. I know many of you love the big caps. So on this week's podcast, I thought I'd take a look at the cheap big cap stocks. We haven't looked at those in a long time, although they do show up in our screens. But this time I thought I'd screen specifically for the big caps with the good Zacks rank. And so that's what I did. So I looked for Zacks number ones, which are the strong buys, and the number twos, which are the buys. That's going to give me a little over 800 stocks. Then for value, I decided, given what's going on out there with the AI revolution, I don't just want the cheap, I do want the growth as well. So how do we find that as value investors? We look for the PEG ratio, which is PE divided by the growth. And if it's under 1, then you are actually getting those earnings cheap and you're getting the growth. This is somewhat of a rare combination to get that PEG under 1. So it's the double whammy. It's the best of all worlds, as I mentioned. So I included that here. And then for market cap, normally the large caps start at about 10 billion and go up. But so many of the large caps are just so big now. I feel like 10 billion is in the mid cap category these days. And so I chose 20 billion and up for this screen to get a little bit bigger in size. And just running those three criteria, I got 22 stocks that matched. So number ones, number twos, peg under one, and a market cap of 20 billion or more. 22 matches. And what was in here was a lot of large cap international stocks. Now, international stocks are back in favor. Maybe I need to do a whole episode with just the international stocks because they are, so hot right now. But many of them are cheap because they have been ignored by the street. Some of them are in the finance area, some big banks, international big banks, and other types of finance companies. But others are not. And I'm including one in our podcast today because you all know it. And so I thought we would discuss this one. But I'm going to talk about three stocks. There is a tech stock in here. And then there is a gold miner. I'm sorry if you hate the gold miners, but they have very good Zacks ranks right now. And if they've got the Zacks rank, we're going to talk about them. Why do they have the very good Zacks rank? Because everybody knows gold is at or near all-time highs. It's over $3,000 an ounce. That is going to the bottom line of these gold miners as long as they're getting the gold out of the ground, which can be an issue in some cases, but as long as they're able to do it and they're selling at this higher price, their all-in costs are about half of what the price of gold is, around $1,400, $1,500, $1,600 an ounce, depending on the company. So you can see the big margins there. So free cash flows are surging and earnings are surging as long as they're executing. So that is an issue with some of these companies, but I'm liking that gold is remaining over this 3,000 level for this entire second quarter, knock on wood. We've got a little bit more to go still, but this is going to be another very good quarter. So the analysts know it too. It's not rocket science if you cover gold miners. And so they're raising their earnings estimates here. And so we're getting a lot of number ones and number twos with the gold miners. But let's start with the large cap international company that I mentioned earlier. And it is Adidas, ticker A as in Adam, D as in David, D as in David, Y, Y. So this is one of those 5-letter companies because it is foreign. A lot of times foreign companies use the 5 letters. So ADDYY. They're a number 2. They have a peg of just 0.59. So that's well under 1. So that's cheap. And they market cap 42 billion. So easily falls in that range of large caps. Now this stock has been struggling. Nike, Adidas, both struggling. Both may have a lot of tariff implications as well. So I'm not going to lie. That is going to be an issue with any of the shoe manufacturers, with the U.S. market. But even if there's a war about what's coming and going from the EU as well with the United States, they could get caught up in it. So I see year to date. Let me see. What are they doing year to date? Year to date, they're still down 1.9%. But they are, have rebounded like a lot of these stocks off of the recent lows, but not quite as much as some of the others. And now starting to see a little more weakness in the shares again. Maybe people are getting a little concerned about, the tariffs again. Earnings expected to come at the end of July. So we have a little bit of a wait there. They do pay a dividend yielding 0.6. So you'll get something for your patience. PE, though, is not as cheap as what the PEG is. It's at 28, but we didn't screen for that. So that's why that, is still included here. PEG ratio, as I mentioned, just the 0.6. So that's what we were looking for. We're looking for that growth. Let me just see if they have any other. Price to sales is 1.6. Price to book is 6.7. So the price to book's a little elevated. Price to sales isn't too bad. It's not at a classic value level, which would be 1 or less, just like PEG, but it is fairly cheap for those sales. Is it cheap enough? I don't know. But you are getting some growth expected there. And so that is maybe what people are most interested in with this one, not the value side so much, but the actual growthiness of it all. Let me look, because I feel like, that a lot of these companies didn't have, but no, it does. So earnings for 2025 expected to be up 86%. So that's where we're getting the good low PEG, even with that high PE. And then 2026 expected to be up 45%. 4 estimates are higher in the last 60 days since the last earnings report. They only made $2.30 last year, expected to make $4.28 on double-digit revenue growth of 12.3%. And then next year, 9.6%. So this all looks pretty good to me, other than the PE's a little elevated, but I am going to pay for that big earnings growth there. I'm getting it cheaply because it's so massive. But is the street just not buying into it? Investors just not believing? Shares did sell off pretty drastically during the Liberation Day sell-off. They have recovered back from those losses, but as I mentioned, year-to-date still down 1.9%. Over the last year, still down 4.3%. So the share is really going nowhere. So it's something to keep in mind. But if some of you were able to get in there on Liberation Day, you did get it much, much cheaper, obviously. And so this might be one you might want to just kind of watch, stay on the sidelines, wait for the next earnings report or any other news, and kind of see where it shakes out. They are in the industry of shoes and retail apparel. It's the bottom 12% of all industries with the rank because of, tariff issues. So that's Adidas, ADDYY. Next stock is the tech stock, and it's DELL. DELL back from the 1990s. And this one has struggled a little bit more than some of the others. For the stock. So year to date, it's down 3.6%, also off those Liberation Day lows. So it has rallied quite a bit off those lows. 1 year, though, DELL shares are still down 14.7%. So still struggling a little bit. It's the Zacks number 2, which is the buy. The PEG ratio is 0.9. So it's just sneaking in there. Market cap of $77 billion for DELL. Forward P 11.8, so that's very cheap. And you do get a dividend yielding 1.9%. That's not too shabby, right? It's better than what Adidas is paying for your patience. They are going to report earnings at the end of August again. So we do have a ways to wait for DELL. And what are those earnings doing? Why do we have the low PEG? Is it only because of the PE being that low? But they are expected to grow earnings 15.9% this year, and then another 11.7%. We have most of the estimates up this year. There is one that has lowered in the last 30 days, but pretty consistent. Most of the analysts are pretty bullish, looking for 943, and they made 814 last year, and that's up considerably from 887 just 30 days ago when they last reported, most likely. So DELL looking like an interesting play here if you are looking for a tech company in the big cap realm that isn't trading at 30 times like a lot of the Mag 7s are, or higher these days. Then DELL is kind of been the steady Eddie, and it has pulled back a bit here and is looking pretty attractive on the big cap side. Market cap of $77 billion, as I mentioned. So this one is considerably bigger than Adidas, but not too huge. So that's DELL, ticker DELL. And then I am going to finish, as I said, with the gold miner. And this time it is Newmont, ticker N as in Nancy, E as in Edward, M as in Mary, NEM. It's the number 2 as well, which is the buy. PEG just sneaks in there like DELL, 0.9. But year to date, this is the one that has soared. Year to date up 46.6%. as gold has hit those new highs. Dividend is yielding 1.9% right now, but that has been changing and fluctuating. Some of these gold miners are paying specials. Some are just doing share buybacks in addition to the standard dividend. So that's something to watch. If gold holds above this 3,000 level, you're going to see a lot more cash being distributed out to shareholders. Also, some debt being paid down, which is also good for shareholders. So you want to see that too. But keep an eye on that dividend because I think a lot of them are going to be paying these specials. Forward PE is 12.8. So that's pretty cheap still, even with the huge run up, because those earnings are also running up hugely. So that makes some sense. We have the rising earnings, and sure enough, we have 2 higher in the last 30 days for this year. 6 were higher in the last 60 days. We're going to get earnings at the end of July, and earnings expected to be up 20.1% this year to 418 from 348 last year. That might not sound super dramatic given what's going on with the price of gold, but remember, these gold miners, it's a lot to get it out of the ground. And some of you, if you're in my value investor portfolio here at Zacks, you know we've had our ups and downs with the gold miners since last year, when some have had execution issues and the shares have sold off because they are having trouble getting it out of the ground, or they've had disappointment in a mine that's just not producing as much. A lot can go on with trying to get the gold out. So if you just want to play the price of gold, the miners is not the place to be. You should be in the gold, the physical gold ETF. But I like the miners in these kinds of market conditions because I do like the free cash flow. And right now, the miners are outperforming what the gold is doing. Let me just look again myself just to see what the gold is doing against some of these. So GLD year to date is up 27%. And then we have the 46% or so in Newmont. So you can see right there, it is outperforming over this year to date, but the gold miners have lagged a bit over the last year. The GLD is still outperforming Newmont, up 45.3%, while Newmont's up just 35.7 in that time period. So, but again, I like the miners here, and just a quick little look at how many of them are Zacks number 1 rank. They're in the top 16% of industries right now, the gold mining industry. That means it's number 40 out of 245 Zacks industries that we track. So that's up there, but it's not in the top 5, not yet. But just scrolling down, let's see. It's supposed to give me, okay. So, not as many as I thought at the number 1s. There's only 4 right now at number 1s, but there's a lot at number 2s, which isn't surprising. A lot of these companies have reported a while ago. So the Zacks rank, surged up. And then because as the rank does, it changes daily. And now it's starting to come back down a little bit while we wait for the next earnings report. So 4 are number 1s, which is the strong buys. And then we have 6 at number 2s. A lot are at number 3s. Nothing wrong with the number 3s either. And most stocks are in the number 3s. It's 80% of all stocks that Zacks tracks are in the number 3s, which is just the hold. And some of that, again, is just because it's kind of off of the highs after it releases its earnings and the estimates are adjusted, and then it kind of just falls back into that number 3 level. But Newmont has not. And we see the estimates are still looking pretty bullish there, and it's still got that number 2 rank there. So those are the 3 stocks. The big caps, if you're looking for some individual big caps, keep an eye on Adidas, ticker ADDYY, DELL, DELL, and then we have Newmont, another gold miner, ticker NEM. All have pegs under 1, so they've got growth and value, and that is a pretty rare combination. Just 22 stocks in this screen. And as always, I aim to bring you as many value stocks as I can. Yeah, I will be bringing you some more small caps, but for now, let's keep an eye on some of these big caps because there are some out there. And I'll be looking for others, maybe looking at price to sales next time. That's one of my favorite screens as well. So again, make sure you subscribe. Get us on Apple, get us on Amazon Music, get us anywhere you can get the podcast. We're on YouTube on our own channel, Zacks Podcast channel. Put that into the search bar and you'll find us. Subscribe there and you never have to worry about it again, but make sure you get us somewhere, and I'll see you again next week with some more value stocks.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.